Hey traders, Nick Shaheen here, looking at an example. Actually, I'm going to answer Pete's question. Good friend, he had a question. He does not do options yet. We had a session where we tried to hammer out the concept, and this is the first actual application that he was considering. So he's looking at NVTA. I don't know the company, and he thinks it's going to go up from here. So he's a new trader, and so far he's had good timing. And so I'm going to trust him that he's using the same instinct to say, okay, this is a bottom. So first things first. I don't know much about the company, and this is definitely not a recommendation for anybody to act on this idea. I am trying to convey the concept of buying shares for XYZ stock and versus buying calls in said XYZ stock. In this case, I do have a real example, so I'm going to use it to convey the concept. So here the idea is that I asked, and he thinks it's falling into support. I don't disagree. It is falling into support. It's actual fact. This is not opinion. Okay, so far it's fact. 4 bounces. These are daily candles. So every candle is 1 day. Bounce, 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 bounce. And then the last time they were here, bounce, bounce. So this is actual fact. And from where it goes from here is the opinion part. So usually I like to see a breakout happen to chase when I'm buying upside opportunity. So in this case, I don't have that. So I do agree it's falling into support, but I don't have an actual trigger to go higher. So that's the only difference of opinion between me and Pete. The fundamentals are neither here nor there. They won't make the argument for or against it at this point in time. I checked, and that's the case. So I won't fight him on the fact that it's going to rise from here, because I don't know, neither does he. He's speculating. I'm not speculating at all. So how would he go long the stock typically? If we hadn't had our session yet, he would go out and buy shares. So if he wants to buy 100 shares, he would spend, what is it today? 35. So $3,500 out of pocket. That's his maximum loss, 100%. He could lose his entire investment in that for 100 shares. This is very similar to using options. With options, you risk X to get long via calls, and that's your maximum loss. So there's no difference. So I'm going to keep coming back to this parallel comparison. Actual stock versus call options. So no difference so far, right? He's going to spend $3,500 to get long. He's going to spend less to get long the same 100 shares using options. There are advantages. There definitely are disadvantages. So you've heard it said options are super dangerous, way more dangerous than stock. It's an incomplete statement. They can be more dangerous than stocks, but used in many other ways, they are safer than stocks, which we won't tackle today. So let's go to the options table. So if he wanted to trade, I have a practice account here with E-Trade. This is called paper trading, like fake money, whatever you want to call it. He could go out and buy 100 shares and spend $3,500. Or he can use options to accomplish almost the same thing. So this is an options table for NVTA, and it has different contracts, different months expiration. Each one of those is a contract span. So this one for June has 60 days on the clock. It expires somewhere in the middle of June, I believe the 18th. So we have calls on the side and puts on that side. We're only going to look on this side now. So what does that mean? So instead of buying the shares, I can use this side to reserve my price. So instead of buying the 100 shares, I can say, you know what, put me down for 100 shares at 35. So this gets me long at 35. See, I could have chosen any other level, but he wants to buy shares or buy calls. So that's the actual replacement strategy. So the out-of-pocket expense is $4.15. But each of them as a contract, they represent not only a level, contract level, time, contract element, right? You get into a contract, there's always a term. You get into a contract, there's always an agreement. Here it's give me shares at 35. And there's leverage. So this one contract represents 100 shares. So I only need to buy one. So my out-of-pocket expense is $420, $415 plus fees. So let's round to 420. That's the maximum I can lose. So in both situations, that's the maximum I can lose. the out-of-pocket expense at the beginning. So 3,500 versus 400. You're saying, I'm sold, let's go with calls. I'm saying, hold your horses. There is a difference. So if I buy the shares, I can sit on them for a decade. As long as the company's in business, I don't have to do anything with them. They hold value, whatever the value is. They go up, they go down. I own them. They don't expire. I own the shares. The company's business, I have the shares. That's different because here it's a contract with 60 days. So outside of 60 days, this contract is null and void, but depends on where price is, the value of it may change. So it's crucial that I pick the right time span. In this case, he could have picked May. I'll show you May in a little bit. If he's coming to me, I would be buying June. I just like some time on the clock. So you're saying, okay, so why don't you go out to September? Because they get more expensive. Just like anything. If you buy if you rent a house for a month, you'll pay X. If you rent it for 6 months, you'll pay more. It's a longer contract. Same here. It's not different. All right. So how can I make money? Well, by me buying the contract, I'm in control. The minute I buy it, somebody gives up control on the other end. Yeah, I'm not buying it off the shelf. There's a person that goes on the other end and says, I'm a seller of these contracts, and this platform marries the two, says, we got a seller, we got a buyer, we got a deal. So all I have to do is just hit execute, and it happens. It's all seamless. So I buy, I'm in control of what? I can say at any point in time between now and 60 days, give me 100 shares at $35. The other side has no, they have no recourse. They have to comply. So if I call my broker and say, hey, I bought this contract, please give me the shares, suddenly the other person, boop, is out 100 shares. They may own them, they may not. It doesn't matter to me. 100 shares show up in my account. So if it goes to 45, like Pete thinks it's going to rally, then I'm in at 35. I paid $4, so my break even is 39-ish. Anything above that is pure profit, and I only risked $400 to do that. Whereas somebody traditionally bought the stock, they risked $3,500. How much money can I lose? $420. That's the maximum I can lose. The money I spend today for one contract is the maximum I can lose. Okay, so why not buy May? Okay, so, or why not do that all the time? Well, that's where the dangerous part comes in. Remember I said they can be more dangerous than stocks? Well, the danger in stocks is that you miss time. But then time is not an enemy. It's once you buy the shares, even if you miss time, you bought them too high. Time is not your problem. It's not a problem. In fact, it's an asset. In this case, it's a problem. Time is ticking, and you only have 60 days. Tomorrow you'll have 59 days. They have 58 days. So it's important. Timing is important. If I start buying willy-nilly, that's the danger part. You're saying, big deal, I can keep track. No, you can't. Let me show you. Let me show you. Now I'm talking against options. So this is somebody on Friday. Today is 4/19, Monday. I don't know if I said that. Somebody that bought this one on Friday, they paid almost $5 for it. They paid $4.80. So today they lost 30% of their money in mere hours because the stock dropped 6%, which is unusual. But the options faster. They lose faster. They gain faster. Somebody that bought the put made the opposite bet on Friday. They doubled their money. So there's the carrot that just keeps people sucked in. Time is an element that is a killer with options unless you get good price movements in your favor. So if I made a mistake using the equities, if Pete got into early but eventually was right, no damage. In this case, if I got in too early and eventually was right, but after the 60 days have expired, in this case, then I got decimated. The money, poof, is gone. That's where it gets dangerous. People start buying left and right and without a plan. At least Pete had a plan. And that's where the second warning comes in. What I do when something goes right or something goes wrong. So his thesis is it's falling into support. I don't dispute that. So if that's wrong, I'm out. So that's what's called a stop loss. So I put an alert, hey, if it falls below 3170, wake me up, I'm out. Because my assumption was that this is a floor and it just broke. I don't want to find out where it's going. That's it. It's as easy as that. But you're saying, but it's not going to go far. I don't know that. It could go to here. What is this? That's not a good foundation to this giant house, a stick with a hole in it. So I think if it loses this, it goes there. It has that potential, but I don't want to be there. So get me out. I'll get back in here. So that's one thing. If things go bad, I need to stop out to limit the damage. So that person that just lost, that bought it on Friday, is down $1.45 on a base of 570 or whatever I said. Did they get stopped out today? If not, I'm asking them, what's their stop out level? After losing 50% of their money, after losing 70% of their money, what is their action plan? So two things I can do. One, set a level where it's out. Two, set a percent. If I'm down 20%, I'm out. That type of thing. So they need good, in order to succeed in options, at least you need a good discipline on where to cry uncle. So they bought it on Friday. Based on what? This as a support? Well, did they stop out because they lost this? Or why? I don't know why. They anticipated a move up, but I don't see the reason why. Well, now it's closer to actual support than just one candle. So arguably this is a better move, better entry point than Friday, but I can't tell you it's going to be a bottom, because there's also the big question mark of the whole market. What's the market going to do? Today was a red day. We haven't had a red day in a while. So is that going to carry over? All kinds of questions. But the method, long stocks, is not time sensitive as much. Being early is not as well, it sucks, but it's not a killer. Whereas being early in options could be a killer. So that's the difference. 100 shares. So how do I actually execute this trade if I wanted to do it? First of all, it needs to be during open session. These don't trade after hours, at least not for this one. And I would simply go pick the one I want. And why wouldn't he pick September? He could. He's just going to have to pay up more or go higher. So if he goes to September and stick with the 35 contract, he's going to pay $600, or go up to 40 and pay less. So is he forced to buy the shares at that price when he buys the contract? Absolutely not. So if I do this, I'm merely reserving that. I don't have to do it. I'm the one that initiates it, saying, give me the shares. So why would I do that and not buy the shares? Well, if I buy this call and 2 days from now the stock rallies, this 400 may turn into 1,000. Like if price rallies, this value grows because now it's in here. See, it gets more expensive the lower I go. So then I can just turn around and sell the contract itself and not even bother with the shares. So if Pete pays $420 for this contract and he gets favorable price movements and the stock rallies back 3 or 4 or 5%, this value turns into 7, 8, I don't know. It just changes, depends on the VIX and how this is an important one here, the implied volatility. So how nervous are people about this stock? So if they get nervous about it, everything gets more expensive. So he paid $420, he got in on the ground floor. Suddenly it's 8. So now he doubled his money. All he has to do is sell that thing back. Say, you know what? I changed my mind. I'm going to sell this contract. I have it. Let me sell it. I paid $410 and now it's worth 8. Give me 8. So he gets out of it for 8. The difference between 410 or 415 and 8 is his profit. So he doesn't even need to buy the shares. That's why they're so attractive, because it's like betting on the price action. And that's what it is. You're saying, oh my gosh, betting, that's gambling. Well, that's what you're doing with stocks. You know, you're betting it's going to go up. You're thinking that, oh, I'm buying this beautiful company. Well, some companies are not beautiful. They're shells. There's nothing in there except hope. Like the space travel companies. They're worth billions, but they don't have anything right now. They just have the promise of space shuttle packed with people going into space. Yeah, they're pre-selling everything, but if they don't actually make the travel, they got nothing. So at some point, it's all gambling. But It's okay if you do homework and you follow a method. Stick to stop out levels, good or bad. So if Pete goes in and the stock rallies, I would get out anywhere around 42.50 because I anticipate it's going to start facing sellers from 41 to 42.50. That's me. I could chase it above that. In fact, I will put the alert right here to pay attention to it, because that means that it's breaking through resistance. So now we're talking about something else. So again, recap, point of this video. If I see an opportunity, I could buy shares to take advantage, or I can buy calls. I just drew a comparison of how one is different than the other, where time is really the biggest killer and biggest difference. When I buy shares, time is not an enemy. When I buy calls, time becomes an immediate potential enemy. And I should therefore stop myself out and be very disciplined. I should have a reason to get in, really good reason, and a thesis, and B, a stop out in case that thesis or reason is bad or is gone. And otherwise, I'm just opening myself up to a whole world of hurt. Options move very fast in both directions. I get it right, I win big. I get it wrong, I lose big. If I do homework and I follow a set process, I limit these wild swings. I mean, surprises happen. I don't know if somebody is expecting 6% drop in this particular stock, but they do happen. And I have to be open to that idea. That's why due diligence is very important. I tried to cut this video down. I promise you, this is the third time I recorded. I can't get it any shorter than this and get all these points across. So good luck. And this is definitely using options. And this is definitely not a recommendation to trade this particular stock, because I'm just addressing the method of trading a stock if somebody has an idea. And this is a friend of mine who has an idea, and I'm just opining at using options versus the traditional method of buying and holding stock.